Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Paniotu, certified financial planning professional in the Cap and Capitalize. Today's episode, we are going to go over the 5 financial pitfalls to avoid in your 30s and 40s. But before we do that, as always, the free advice and tip of the week. Focus all of your energy on your craft to make the most money possible, not any particular investment. No company, piece of real estate, you name it, is going to outpace you. You have all the tools in your arsenal to become financially successful. And as long as you focus on that and shut out the noise, that is going to lead you to the ultimate level of financial success. And you see this a lot today when you talk about like the side hustles and getting into a side job or, contracting here, contracting there. What if you just focused everything on your best professional attribute? That's where the compounding is going to come into play. And then later on in life, you don't have to try to hit that Hail Mary because you haven't made as much money because you've been distracted everywhere else. And that's where people start to get really careless on the investment side of things because they haven't made enough money based on their craft that they need to get desperate and they take an insubordinate amount of risk that they don't need to take with their money if they listened to this free tip of the week earlier in their life. So enough about that. We are going to get into the financial pitfalls to avoid in your 30s and 40s. But before we do that, I want to mention that the episode I wrote and recorded, the 10 best financial tips for listeners in their 20s, all of those things still apply. The difference between this episode and the episode where I went over the 20-year-olds, unlike that where I focused on what to do, in your 30s and 40s, you're actually going to want to focus more so on what not to do. And the reason why I bring this up, and this is really, really key, most people start to truly compound their wealth starting in their 30s and especially in their 40s due to the simple time value of money. And another reason why I'm bringing this up is because, when your money starts to pile up relative to your 20s, people jump to this conclusion, and I really don't know why, but you suddenly need to get creative, cute, fancy, whatever that term is with your money. And that is the farthest thing from the truth. So with that teaser, let's start digging into the 5 financial pitfalls to avoid in your 30s and 40s. And there's a number of them out there, but I picked the top 5 that I think are going to be the best for your eyes and ears. So the first one, and this is in no particular order, but the first one that we wanted to go over is leveling up your lifestyle as your income increases. So in your 20s, one of the easiest ways to make sure you don't go backwards is to live within your means. But for whatever reason, and again, this is a head scratcher for me, when people start to make more money, and I'm not talking like a little bit more, I'm talking about, significant more, maybe a 10 or 15% pay raise year over year, your career really starts to blossom. For whatever reason, then that advice that got you to have some financial success, it goes out the window. And there's this, maybe it's just this false sense of, this can keep happening. And I'm going to continue to get these 10 to 15% pay raises year after year after year. And obviously that's not true. I mean, eventually there comes an end to everything. And so one thing that I think about, and I think this is valuable for you, is if you kept living the same level now as you did in your 20s, and assuming you're living comfortably and you're not like barely scraping by, why do you need more? And I should say more, like quote in quotation marks, because instead of, just trying to keep up with the Joneses or whatever the case may be, or leveling up your lifestyle for really no apparent reason, this extra money, it just gives you the ability to save and invest even more. And that leads to either an earlier retirement and or a more prosperous retirement where you can truly enjoy whatever you'd like to do. Now, I actually like to use an example with this, and I've thought about this where, my wife, Stephanie, and I, we started to see our life truly turn the corner when we were about 30 or 31. And I can tell you the first couple of years of us, living together and then being married, like it was financially thin. And that being said, we were as prudent as we could be. And then when we started to make a little bit more, we've still kept the same lifestyle. I mean, we're not into flashy things, status stuff. Like it isn't, that's not really us. Like I try to wear as fashionably affordable clothes as possible, which is why I'm rocking Bad Birdie, and so on and so forth. But it's interesting because we've also seen some of our friends or colleagues, and it's odd because they're still living paycheck to paycheck, and I'm using quotes if you're just listening. But they're still making like 25, maybe 50 grand more than they were making in their 20s. And obviously inflation plays a part in that. But if you went from making, let's say, $50,000 to $100,000 or $100,000 to $150,000, that's above and beyond inflation. And inflation is now not the issue. It's just you keep leveling up your life inappropriately. So you want to avoid that. Now, the second thing you're going to want to avoid is don't overlook the easy wins to a successful financial life. Now, far too often, and I see this come across my desk, where clients in their 30s, in their 40s, they're making some serious money, yet they're not maxing out their 401ks or utilizing, if you're making a lot of money, you would use a backdoor Roth IRA, which, quick little tangent, if you make too much money, you cannot put into an individual retirement account and get a deduction for it. Now, the exception to that is if you don't have an employer retirement plan, you do get a deduction for an IRA. But assuming you work somewhere and they have a 401k, because most companies do, and you're maxing that out, instead of putting money into an IRA without getting a deduction, you put the money into an IRA, but then the next day you convert it or roll it into a backdoor Roth IRA. And what's cool about that is you've paid the tax today, and then that money grows tax-free. Kind of a cool little workaround. So with all of that, I want to go over some strategies that you should look into before you think about doing anything crazy or creative or sexy with your money, because chances are you're missing a lot of the easy wins. So obviously I went over the 401k, and let's actually order this. So until you max out your 401k plan, you should not look to put your money anywhere else when it comes to a retirement side of things. If you work for a church or a nonprofit, that's generally speaking a 403B plan. And if you work for the government, it's a 457B plan. But they're all based the same relative type of retirement plan. There are some slight differences here and there, but that's beyond the scope of this episode. So with your retirement plan, as of 2024, you're able to put in $23,000 if you are under 50, and then if you're 50 and older, $30,500. Okay. The reason why I bring that up is obviously that's a lot of money. And so until you've maxed that out, people are going, well, I'm never going to get there. Great. That's totally fine. We have clients that have retired with a couple $1 million in their retirement plan, and they never set up an individual account. They never set up an individual retirement account. They never maxed out their 401k and came remotely close. And guess what? They've just got this lump sum pile of money that then rolls into an IRA when they retire, or if it's a Roth 401k, Roth IRA when you retire. And they have a successful and simple life. I mean, no one's going to ask you how you made your $1 million in the terms of, did you do it really creatively? Did you do it really simplistically? The fact is you had $1 million. And so why don't you make your life easy? So first thing is you want to start off with the 401k. Now, if you have a health savings account at your company, you would be a fool not to use it. It is what we call the triple whammy. So you put money in before you pay tax, it grows tax deferred, and then if it's used for healthcare purposes, and you do not have to wait to retirement for this, it could be as soon as this year, that money is tax-free. And there's a litany of things that you can use your HSA money for. You're going to want to talk to your HR supervisor on that, and then they'll give you all the information. So 401k, then max out the HSA. Then you'd want to look at like backdoor Roth IRAs, or if your company doesn't have a retirement plan, then you're going to want to set up just a regular IRA. And let's say that there is a spouse in the house that is not working. You could set up an IRA for him or her and put in money and get a deduction that way. Okay. But then if you're both working places, backdoor Roth IRA, fantastic. Then after all of that, if there is money to play with, so to speak, and be prudent with, that's when you could look into investing in maybe like a joint investment account where you could get a little bit more creative, whether it's a stock portfolio, index fund, mutual funds. It's really up to you. Real estate, private equity, lending, you name it. Now, this isn't the most fun topic to talk about, but if you are married and you have kids, and this is financial pitfalls to avoid in your 30s and 40s, and there's a pretty good chance a lot of you will have kids or family. So if that's the case, and you want to make sure that your family's okay if you die prematurely, life insurance, it's a must. And I actually want to take a moment before we go to the commercial break and briefly explain everything that you need to know about life insurance, kind of regardless if you have a family or not, okay? So there's two types of life insurance. There's temporary insurance, which is known as term insurance, and then there's permanent life insurance. And most famously, there's whole life, but there's universal life, index universal life, variable life. There's a ton of variances with that. Term is for if you die. Permanent is for when you die. So if someone comes into my office, and let's say they're in their 30s, they're doing pretty well, they want to make sure that if something ever happened to either of them, the other one, and let's also assume there's kiddos involved, are taken care of. So one of the easiest things to do is say, okay, let's say that you have a mortgage, $500,000, student loan debt, $100,000, there's $600,000. And then if you want to get really, above and beyond creative, you go, okay, so if I passed away, our monthly expenses are, let's say, $4,000 and a month. And then I want to make sure all of that is replaced if I passed away. So the easiest thing to do when it comes to term life insurance is to go, okay, you add up those debts. So in this case, mortgage, student loan, but any debt that you have, you'd want those paid off if you've passed away. And then there's this rule called the 4% rule in our industry. And it's not like a perfect rule. I actually had the founder of it way back on the podcast, Bill Bengen. This guy's like the Tom Brady of financial planning. He is the GOAT. And what he did is in 1992, he said there is a rule called the 4% rule, meaning if you take 4% out of your portfolio at the beginning of every year, there is a 95% chance that your money will outlive you because you don't want to outlive your money. Okay, great. So then what you would do is you would take that 4%, multiply it by 12 months, and then divide it by 4%. And that lump sum would be what your family would need to replace your income, okay, if you passed away prematurely. So you take that plus all the debts. That's what I would look to do with the term insurance. Now, permanent insurance It's a little bit more complicated, but I'm going to make it as easy as possible for you to understand why you would or would not use it. So chances are, if you're in your 30s and 40s and you are motivated and you are really trying to make a name for yourself and your family self, financially speaking, you're probably going to be worth a lot of money down the road. So the easiest way for me to explain permanent insurance for people is, let's say down the road, you make it to retirement. So the term insurance lapses, it goes away because term is temporary, but then you've got this permanent insurance policy. So when you invest in a permanent insurance policy, life insurance, you've got, that was redundant, I'm sorry. You've got the death benefit side, which is the life insurance, but then you've got something known as the cash value. Now, I'm not going to try to complicate it any more than it already is, but the cash value portion of permanent life insurance is where you can actually get really creative with it. So let's say that you've been paying into this over the course of your working years, and you get to, let's say, age 60 and you want to retire. Most people like to. Well, at that point, what you can do is you can take some of the cash value from your life insurance policy that's grown over time, and you can actually draw down some of it, in some cases tax-free, to use as a retirement income source, which is super, super valuable. Now, let's say that you don't even need to take the cash value, okay? Well, then you could keep compounding it for, long-term care expenses if that was something that you needed, disability, things of that nature. But the main thing is estate planning. So, and this is really popular in our state of Washington, which is where I live, and our state has a state estate tax limit, which basically means if you have non-retirement net worth, so forget your 401k or your IRA or any of that. If it is a non-retirement account, so an investment account, maybe your home, things of that nature, if you are worth above $2 million, and it's graded on that, but basically 40% of that goes to our lovely state. Okay, so if you're worth $10 million, and let's say that you're married, so each of you get the $2 million exemption, 10 minus 4, that's $6 million. 6 million times 40%, that's $2.4 million. That goes to our lovely state capital. So then the question becomes, well, that kind of sucks because you're not growing your money for the government. You're growing it for your heirs in your legacy, and you want to choose what you want to do with it. Well, your life insurance policy, your permanent life insurance policy, becomes an estate planning vehicle. So what you could do is you could set up something called an ILIT, an irrevocable life insurance trust. You take your permanent insurance policy, you put that into the trust, and then that trust, when you die, the death benefit pays for the taxes that your estate will owe. Pretty cool. So I know we got super into the weeds with that, and then federally, let me also just say this before we go into the commercial break. The federal tax limit right now is about $13.5 million. It's probably going to sunset in 2026. That's a whole nother story. But the whole point with that is permanent life insurance can be used for a number of different tactics when it comes to financial planning, whether it is like a term policy, whether it's using it as income in retirement, or the most classic is an estate planning vehicle. And I want to say, and I want to be crystal clear, it's not like I'm suddenly like, oh my gosh, I'm a huge pro permanent life insurance strategist. That's not what I'm saying, okay? As a prudent planner, as a capitalizer, I am just telling you everything that you need to know with this. And it's not an either or, it is an and it is very important to look into that even before you try to get creative and sexy with your investment. So with that being said, because I know that is a lot, this is a perfect time for me to transition into the commercial break. And then when we come back, we're going to close out with the next 3 financial pitfalls to avoid in your 30s and 40s. Stick around.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back from the commercial break. Let's get right into it. I know we went over a lot before the commercial break, and we got a lot more to cover, but hopefully it won't be as complex as the number 2 that we went over before we transitioned on. So with that, number 3 of the financial pitfalls to avoid in your 30s and 40s, don't compare yourself to your friends' financial situations, with an asterisk. So some of the taboo things you simply don't discuss. You don't talk about sex, you don't talk about personal health, and you don't talk about finances. And at least that's how it was when I was growing up. And it makes sense why. I mean, none of those are really anyone's business other than your own. Now, professionally, there are a ton of people that I've met who have, quote unquote, a lot of money, but they also don't have anything at all. And let me explain that a little bit. So early on in my career at one of the big firms, there was an advisor that explained to me the concept of income sheet wealth and balance sheet wealth. And it always stuck with me. So income sheet wealth is basically someone that makes a lot of money, but they also spend it. Balance sheet wealth is what you're worth. And actually, that is true when you're analyzing a business. If you want to know what the business is worth, look at the balance sheet. And then if you want to know how much money they're making, you look at the income statement. And the reason why income sheet wealth is not that great is when you're making a lot of money, you're living high on the hog. When you're not making a lot of money, your life kind of sucks. And you live very, very frugally because you literally have nothing to fall back on. Balance sheet wealth, you kind of become a financial fortress. And I like that. So, you know, and I mention that because just because you see all these people making a lot of money, you actually have no idea what they're making or what they're worth. I mean, I have a little bit of a different advantage because with what I do, I see people's financials and, you, as one of my buddies said, we get to see where the bodies are buried, but most people don't have that. Now, I want to mention something that I brought up, and it was the asterisks, okay? I don't totally agree with this statement of don't compare yourself to your friends' financial situations. And let me explain that. So many different ways I could skin this cat. One of the big ones is, let's say that you have a friend or a family member, okay? Or a mentor, which I just can't stand that term, but like someone that you look up to a lot. And you know they've done exceptionally well for themselves. And you know it's not the income sheet wealth. Like it's legit. And they're very humble about it, and you just know fact of the matter. For those circumstances, I would 100% take them out to lunch, take them out to dinner, coffee. Take the time to learn how they made their money and how they got to where they are financially. I would not, and this is very big, I would not try to copy them verbatim because you are not them and they are not you. But I would absorb as many mental models as humanly possible and apply that to your life. And for those of you that are unfamiliar what a mental model is, I just want to take a moment and briefly explain. So we've talked about this in the past in when I went on the Millennial Investing podcast a couple months back. Kyle Grieve and I, who's also been a guest on our show, we talked about mental models extensively. And a mental model is basically a framework that you can take from some aspect of your life and you can apply it to other aspects of your life. So I'll give you I'll give you a quick example, and then we'll keep moving on. So I grew up golfing, okay? Now, if you don't golf or even understand the game of golf, this obviously analogy is going to go out the window. But I have used analogies with investing, and I've applied them to the game of golf. So like when it comes to like investing and planning, are you going to hit a home run every single time? No. Okay. You're just not. Okay. But you'd like to be more right than wrong. And so that's when you come into the idea of when you're constructing a portfolio, you need to be very prudent in your approach, and you can't let the emotions get the best of you, and you just need to let the facts guide what you need to do. So how that works in the game of golf is, let's say you've got a hole that's 400 yards and it's a par 4. And I mean, unless you're a pro golfer like Bryson DeChambeau who can smack it a country mile, you're not going to drive the green. I'm just going to speak for as a guy. Most guys are ego golfers. My brother and I have golfed with plenty of them. And so they take out the driver because it goes the farthest, and guys want their testosterone flowing and they just want to rip the ball. Unfortunately, that club has the largest margin of error. And so what ends up happening with a lot of these guys is they hit it way far left or way far right. Now they're under a tree and they need to bump it out, and then they just cost themselves a stroke, and suddenly they're bogeying or double bogeying at the best, and that just basically catapults the rest of the round into depression. So instead, I look at the hole and I go, well, why don't I just take the length of the hole and I divide it by 2? And then I give myself a little bit longer of a distance, and then I hit that club. And the reason why I hit that club is I might hit it, 225, 250. I know because by the time I'm about 150 yards out, 1, I'm much more accurate with the lower clubs as opposed to the driver. And then 2, by the time I get up there, I'm even more confident with my shorter clubs. And so by the time you get on the green, okay, great. You 2-putt for par. Occasionally you get a birdie, which is great. And occasionally, putting just is not your game. And so you might hit a bogey. Is that going to kill your game? No. But then when you add that up over the course of your golf round, people are going to look at you like you are the best golfer of all time, or for sure in your group. And it's no different than investing and planning. You don't have to hit these massive home runs, but I guarantee you over time, if you apply that mental framework like I just laid out in golf to your money, people are going to think, man, you are like the next Warren Buffett. And you weren't. And that's okay. You were just really prudent with it. Now, back to the topic of don't compare yourself to your friend's financial situation, because I know that was a little tangent. There's another exception that I want to go over. If you have a friend where the two of you are in a very similar financial situation, and you guys know it, like you just do, this is where when you have a similar situation, ask your friend what they're doing and like bounce ideas off of each other. I would say the best way to learn is to teach. And here's another thing. As you start to build success, and this is specifically to financially, but you could also say with everything, with your career, family, you name it, there are going to be less people as you climb the top of that metaphoric mountain. And so if you find someone that is right alongside you in your life journey, you want to hold on to them for dear life, and you want to ask those questions because, again, the more successful you become, there's fewer of you out there, and the fewer of you that there are, the less chance you have to bounce ideas off and really just hone in your knowledge. Now, number 4, never assume you are done learning and never assume you know it all, especially when it comes to money. So the world of finances constantly changes, and that is the understatement of the year. And it really doesn't matter what you are trying to do when it comes to capitalizing on your finances. What works today may very well not work in the future. And there's a couple examples that I actually want to go over. So back in 2018 and 19, interest rates were dropping, and they were they weren't where they were in 2020 or 2021, but they were dropping. They were heading in that direction. So for clients that were about to retire or had retired, for monies that they needed today, we were using fixed annuities in our practice because it was pretty cut and dry. Interest rates were high enough where you could actually earn a nice return on it. And in 3 to 5 years, they're guaranteed, so you're not really taking any risk, and it fit within the plan. Well, you fast forward to 2020 and 2021, interest rates were so low that utilizing a fixed annuity was a behoovement to any client at that time. We're talking new fixed annuities, okay? And so when I was looking at that, I'm going, oh my gosh. And it happened so fast. I mean, you could say it was within a year or two, but life tends to speed up as you get older. Now, you could also use the same example with long-term investments. So what happened in 2022? The market took a hit. Real estate absolutely catapulted. Venture capital took a hit. Private equity did kind of exactly what it needed to do. Lending, business development companies actually earned a higher return. And all of that was tied to interest rates. What happened in 2023? There was kind of a reversal of a lot of that. Lending companies, again, they did exactly what they said they were supposed to do. Market rebounded. Real estate pulled back in value. Venture capital exploded from their lows in 2022. And the reason why I bring all this up is that was just a year, and in some cases 6 months, where everything changed in the blink of an eye. So I try to make money as simple as possible for you all that listen in, okay? But I can tell you right now, money it is by no means an easy game to master, and you never master it, okay? Now, let's say that you're investing on your own, and many of you that are listening into the show are interested in doing that. We could get really granular with how quickly things change in a business. So what if you invest in a company that you think is really simple, it's got a long-term track record, all that fun stuff, and then after one quarter, you start to notice things that are changing the business drastically, whether it's a number, whether the CEO suddenly gets a different tone in their voice when it comes to the business. Should you still own the company? Should you bail? If you want to continue to own it, how much should you own relative to the rest of your portfolio? I mean, it's one of those things where you got to ask yourself constantly, am I doing the right thing? And can I avoid the imminent losing everything if you take your eye off the ball? And you could even think with interest rates, right? So even though you're in your 30s and 40s and you've got a long-term time horizon, what if you're trying to save for a home? And what if you're maybe adding on and remodeling like we're doing right now? How does that affect online savings accounts and bonds and CDs and money market accounts? So I know I'm throwing all of this at you and you're probably like overwhelmed and you're going to have to pause and come back and re-listen to all of that. But it's the honest to God truth. You can never assume, oh, I know all of it. And trust me, there have been a couple times, only a few, but a couple times in my career where I'm thinking, I've got this. And that is a great way to, one, be mortified because you're humbled really quick. And then two, frankly, you're actually going to be called out for it. Whether it's a mentor, maybe reality happens and your investments that you had so much confidence in suddenly don't pan out. There's just a lot that you want to prevent by having that inappropriate mentality. So never stop learning. And that's what the most successful people do. The last financial pitfall to avoid in your 30s and 40s before we close this bad boy out, don't focus on and this is a little bit different than just money. Don't focus on the quantity of people in your life. Hone in on the quality. So in your 20s, when you're getting going in your professional career, most people don't know a ton of people within their professional community. And so networking, it's a non-negotiable. You've got to do it. And in your 30s, in your 40s, networking doesn't, it definitely doesn't stop per se, but it certainly evolves. So professionally speaking, you actually start to narrow who you choose to spend time with. And this goes beyond the return on time with these people. At this point, it is really about quality friendships. I mean, if you're going to work with someone for 10, 15, 20, 30 years, you better as hell like them. Because if not, you are going to be miserable as hell. And if you just choose to stick around, that's kind of on you. And most people have that choice to not, okay? Now, one common mistake I see people make is that, it's actually a two-parter. They either hang on to like dead weight people that really have no need to stick around in their lives. Like it's not an overall net benefit for them to be there. Or I've noticed this, people get really nervous that by losing people, there's not going to be a replacement to that person. And I actually want to touch on the latter first. So there's a saying that everybody's replaceable. We've heard that before. That saying comes only from those that are actually replaceable. So if someone is telling you that, they are doing you a favor. They are telling you that they are replaceable. And I can guarantee you that there are people out there that are not replaceable that would love to be a part of your life. And it's actually a mental model I've learned in investing, and I've applied it to my own life. And I'm not saying, and I want to be crystal clear on this, I am not saying that you are suddenly better than those people. And I am not saying you should look down on these people or any of that negative nonsense. That is not what I'm getting at. What I am saying is just by matter of fact, just be matter of fact about it and ask yourself what they are doing in your life. And if there is a truly profound, irreplaceable reason for that presence, you know you've got to keep her. But if they actually believe everyone is replaceable, they just told you who they are. And as for the idea earlier of, now I suddenly have one less friend, I would say, I would look at it differently. I would say that, let's assume you have 6 friends before all this. Instead of 6, now you have 5. Those 5 friends all have a high quality of, and we're talking of characteristics. So your average weighting of quality just skyrocketed. It's no different than an investment. If you got 6 companies in your portfolio and one of them is just a loser and you go and sell it and you got 5 winners, why don't you apply the same analogy to life? I don't get it. I really don't get that. It's diversification 101. Like why in the world of finance, we're always told, hey, you need to diversify your portfolio. You need to have your top 100 ideas. Why don't you just have the top 5 and then you get rid of the worst 95? I don't know. So don't hang around with dead weight. That's a great way to close this episode out. 5 financial pitfalls to avoid in your 30s and 40s. As always, Christopher Ponio to the Cap and Capitalize. See you next week. Keep capitalizing. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Poniotu, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
Capitalize Your Finances and LPL Financial do not provide legal or tax advice. Please consult with your tax or legal advisor regarding your personal situation. This material was created to provide accurate and reliable information on the subjects covered, but should not be regarded as a complete analysis of these subjects. It is not intended to provide specific legal, tax, or other professional advice. The services of an appropriate professional should be sought regarding your individual situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss in a declining market. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. CDs are FDIC insured to specific limits and offer a fixed rate of return if held to maturity, whereas investing in securities is subject to market risk, including loss of principal. Fixed indexed annuities, FIAs, are not suitable for all investors. FIAs permit investors to participate in only a stated percentage of an increase of an index participation rate and may impose a maximum annual account value percentage increase. FIAs typically do not allow for participation in dividends accumulated on the securities represented by the index. Annuities are long-term, tax-deferred investment vehicles designed for retirement purposes. Withdrawals prior to 59.5 may result in an IRS penalty, and surrender charges may apply. Guarantees are based on the claims-paying ability of the issuing insurance company. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions, and it may not achieve its investment objectives. All investing involves risk, including loss of principal. No strategy assures success or protects against loss in a declining market. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Christopher A. Panayiotou is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. LPL Financial, California license number 0518721. LPLIA, California insurance license number 0B91442.